What's going on, guys? Nick Sean with MFX here. Today I'm going to be going through a few examples of how to draw Elliot waves and where to take trades and where to put take profit and stop loss. I know some of you may have a few questions about this. Sometimes it's a little bit tricky to get it, but after you get it, it makes for very good trades. So let's just start scrolling through the market here. All you're looking for first is a range. Looking for the market to go into a range and then break out of that range and then start making a breakout pattern in 5 waves. So right here, we could say this was a little upwards range. You see the market was going upwards for a while, or maybe you could draw it, further up here if you like, something like that. And if you want to put the top line in, you can too. It's just the market's in a channel. It's in a little area where it keeps bouncing around up and down. And the market breaks out and retaps that channel before continuing. So the whole idea is that you want to see a breakout retest and then a further breakout, then the market pull back, and then a final breakout downwards before the market turns around. So this wasn't clear enough right here. If you were looking at this from an Elliott wave perspective, here's our range. Market breaks out, that's wave 1. Market comes back and has to retest that range. So this was wave 2. Then wave 3 could be considered this, but wave 3 is typically really long, and it's typically like the big chunk of the move. When it's just like a few candles like this, I mean, this is a minute 1 chart. This is like 4 minutes from here to here. So it wasn't really a huge sustained move. Wave 3 should be extensively long, and then a pullback, and then another move down to wave 5. So the market just kind of chops around. This is almost another range just going downwards. So no trades to be taken in there. It's not clear enough pattern. You want to see a clear 5 moves. When we find a clear pattern, I'm going to draw it up and I'll show you where your trades go. Market's moving up right here, so this is sort of a little ascending range right here. So there's our area. The top, as well, you can draw the top if you want. You don't really need it, but just understand this is just a channel where the market's bouncing around. Breaks out of that channel, but it didn't come up here and retest this. So we have wave 1, kind of. This is a very small breakout, but we don't have the market test this area before falling further. So this is a no-go. We would just stop looking right there. So this is sort of an interesting area. We can see this is an area that's very active. We can see the price is tapping around this area, goes up, kind of plays around right here, comes back, taps that before falling. So if you like, you can count this as wave 1. This is wave 2. And like I said, these are discretionary sometimes, guys. You just have to look at an area that the market interacts with. So you can see the market is tapping along this area, right? Every time the market gets to this area, it sort of interacts with it. So this can all be considered like a range. The market breaks out of that, then plays around, and then comes down and breaks below it, comes back and taps it, and then starts heading downwards in a big move. So this is very, very clear right here. So here's how I would look at this. Let's see our range right here. Market breaks out, that's wave 1. Market comes back, taps the area on the underside before heading downwards further. This is going to be wave 2. This is going to be wave 3. You typically won't know what wave 1 and 2 is until it's confirmed with wave 3 moving away from that area. So then you'll know, okay, we had a little sideways area right here, and the market broke below that and tested it. You could even maybe draw it like that. You see if you wanted to. This is a little choppy area, comes down, taps it. Or you can just use the horizontal range if you like. But yeah, there's a bunch of ways to do it. Just identify an area where the market's chopping around within a range, we just call that a channel, and then wait for the market to break out and retest that area. So yeah, you can do it a couple ways. Anyway, so after it breaks out and retests, that's wave 1 and 2. You have to have wave 3 come down more. Wave 3 came down very extensively, pulled back. Wave 4 will typically test where wave 1 ended. So it's almost just like a little stair-step pattern. So we can do it something like this. Essentially, the market came down, went up and tapped this area where this low was made. So if we're looking at this, the market's going sideways right here, comes out, taps that, falls, comes out and taps the previous area that it left, the previous low, then falls even more. So if we're counting these, here's the range: 1, 2, 3, 4, 5. Now at 5 is where you want to take trades. What sometimes happens is you'll see the market come down here to wave 5, pop up and make another divergence down here, or you'll see that this wave 5 is divergent from this. So if we're drawing out the divergence along with an indicator like the RSI, we can see that the two things are doing different. RSI is flat while these are down. So this right here is a divergence, and it is also a tradable divergence. There's the first peak is at or near the 25 level. That's good. We have a clear upside down U or V movement, so this is good. Rule number 2 is in place. Rule number 3, price in the main chart makes a clear lower low. RSI makes a clear higher low. RSI was flat right here. This isn't really a higher low, but at the same time, taking it into account the wave 5 on the Elliot waves pattern, we know, okay, the market is going to start trying to reverse anyways right here. So yeah, I mean, if you bend the rules a little bit, like a tiny bit, then yeah, you can still say that these are still flat, but this is going lower. So these are still technically diverging. But like I said, not the pitch perfect 100% setup, but the market still came in a lower low while RSI failed to make a lower low. So rule number 3 would be in place for the most part. It's just divergence. You're looking for RSI in the main chart to be doing something different. So we have divergence here, and then also it has to be on a fast candle. So this was a huge, big, fast candle that made a clear lower low than this, so that would be fine, fast candles. And rule number 4, there's less than 20 candles. So rule number 1, 25 level right here. This is good. Rule number 2, clear upside down V or U movement. This is a perfect like U or V, however you want to call it. Rule number 3, divergence right here on a fast candle. This one's lower, this one's flat when you compare these two. Rule number 4, there's less than 20 candles in between these two peaks. So you're taking that into account. So we have a pretty good divergence right there. So it's a good indication to buy that the market may make a reversal. Second indication is that we're at the 5th wave of an Elliott wave pattern. We had a range right here. This is like the highest area, right? There's nothing higher on the recent price until right here. So this was the high and it went into a range, came out, retested. Okay, 1, 2, 3, 4, 5. At 5, you can ask yourself, is this divergent from the previous peak? If it is, you should typically be good to buy. So how you buy is right here, we're on the minute 1. What I would do on the minute 1, I hold anywhere from 5 to 10 pips. So if you would have entered, you could have entered right here or down here. Even right here would have been a pretty good entry. You would have gotten a little bit of drawdown, but you can enter in these areas right here. And what you're going to do is typically what I'll do, if the market is moving fast enough, you can take your profits anywhere from 5 to 10 pips. So a good rule of thumb is on the minute 1, sometimes price can be slow and choppy, sometimes it can be very fast, and one candle can be like 20 pips long. Like it's crazy, especially on GBP, JPY. So here's what I do. Whenever I enter a trade and I usually take my profit at the other previous support resistance level. So for instance, the previous level would be somewhere like right in here, because this was our previous area. You'll notice that when the market comes below an area, it comes back and it tries to test that area. It's like this right here before it drops away. So it couldn't get back up, so the sellers won. Market comes up and it retests this area, this previous area right here, the previous low. It can't get above that area, market comes down. Then the market comes up here and tests this previous area. See where this previous low is? Because that's the previous low, that's the previous support resistance area. The market taps it and it has trouble getting past that, so it comes down, but instead of making a lower low, the buyers start to gain control because the buyers buy up price right here as soon as it's on a discount. So the buyers run up price, they get back to this level, fall again for a second, but then shoot up above that level. So that's a good sign. Then price comes down for a test, and price tests this area again before continuing up. So where's our trading? Our trading is just all right in here for this little move here. You could have held this trade for 5 pips, which would have been somewhere from here to here, or 10 pips, which would have been somewhere from here to up here. Your stop loss, typically what you want to do is you want to run a 1-to-1 risk reward, but you also need to take into account price action. So here's what you could do. If you just want to be black and white, which there's more to it than that. There's more discretion than that. But if you just want to be black and white, you want a clear rule. If your take profit is going to be 10 pips, set a stop loss 10 pips below. Now, you're going to lose more good trades like that because that completely ignores price action and watching what the market's doing. So let's use an example. If you entered right here on a buy, thinking you're going to go right into profit, you're going to make money, you enter a buy right here, right? If the market quickly goes up into profit, that shows, okay, there's a lot of buyers in here, so you're good. It's quickly going to your profit target. You're good to hold 5, 10 pips. You can be out. But if you enter here and the market starts going up but quickly goes and makes a lower low, what I do is I enter again. I stack a position. It would be somewhere down here on the chart. on the main chart. It'd be somewhere down in here. I would enter again another buy, and I would hold my profit target just a few pips past the first one. If it goes substantially lower, like 10 pips lower very quickly, then I'll enter another buy as well, and I'll hold my trade just 1 pip past the first entry, so maybe somewhere in here. So that way you're making 10 pips on your entry that was lower, and now you're getting 1 pip, pretty much break even on your first entry. So you made all your money on your second entry. So that's a good way to manage your position if the market goes against you very quickly. However, if the market slowly starts going sideways, ask yourself what that means. What does that mean? If I see the market come here and quickly jump back up, doesn't that mean there's a lot of buyers right here? There's a ton of buyers right here. There's so many people willing to buy right here because the market responds very well. As soon as it gets that area, as soon as the buyers get this huge discount down in here, they jump price up. They all jump in, causing price to run up. They get another discount. Price starts running up very quickly again. So that's good. But what happens whenever the market comes and then no one buys? What happens is you'll see the market will come right here, and maybe have a bounce from a few buyers, then it'll come back down. Then it may have another bounce, and then it'll come back down. Then it'll have a smaller bounce, and the market just does this sideways thing. And eventually, if the market goes sideways long enough, what happens is you'll see a breakout downward, because there's no one buying. No one's willing to buy at that price, so the market generally goes lower. So what I do is if I enter and the market starts slowly going against me, what I'll do is I'll close the trade at a small loss as it consolidates against me. Now, small loss, quote unquote, is discretionary. It can be 5 pips, it can be 10 pips, it can be 15 pips. What it should not be is something that blows your account. It should not be something you get into a 50 to 100 pip drawdown on the minute one over. You just want to manage that trade and make sure that you've identified a proper wave pattern before looking to take divergence, because it just gives you so many confirmations of what's going to happen. So I know everything I just said may come off as a little bit confusing, so I'm going to break it down very simply again. Where do your take profit and stop loss go? If you enter here based on the divergence that we just talked about in combination with this 5-wave patterns, if you enter here and the market quickly goes up into profit, and the market holds and you see a lot of good price action like a bullish wick right here, that tells you, okay, you should be good to hold all the way to your biggest profit target. In this case, my biggest profit target on the minute one would have been 10 pips. 5 to 10 pips, you would have been good. That worked out great. Now, second scenario, if you buy right here and the market tries to go up but comes back, tries to go up that comes back, tries to come up and goes back, and it starts going sideways and then it starts trickling down lower, you want to close your trade with a small loss, because that just means that, yeah, you're buying right there, and maybe a few other people are, but there's not enough big smart money. There's not enough big hedge funds, banks, big financial institutions buying at that price, which will cause price to run up, which will cause you to make profit. There's not that going on. There's just no going on. There's no buyers. So what you want to do is you don't want to stay in a trade like that where it just starts trickling sideways. What I do is I just close my trade at a small loss. I go to the next one. Usually you can make your money back within the next trade or two. For sure 3 or 4 trades. It shouldn't be something that like wipes you out though, especially if you're winning 90% of your trades. A small loss is not going to hurt you. Just maybe 2 or 3 trades later, you're back to break even, maybe even in profit again. So that's the first scenario and second scenario. Now the third scenario is if you buy, price comes up and then quickly spikes down against you. What you're going to do is you're just going to add another entry lower if the market comes down a lot lower here in the main chart, somewhere down here. You know, if I could extend the chart down. And what you're going to do whenever price gets there, you're just going to buy again and then close both your trades in profit after the first entry you enter goes into profit. So essentially it looks something like this. Wave 5 comes up but then spikes lower down to here. Stack another entry, hold both entries, you know, until it's 5-10 pips past the second entry, or just 1 pip past the first entry. Just pretty much get out, break even on your first entry, and take all your profits on that next entry. You got to understand, fast moves like that, when the market's already overextended, fast moves downward, it's just market manipulation. It's made to scare people to think price will continue. You'll notice a lot of fast movements are made to just freak people out. So like for instance, right here, see the market's going up, we're in a little uptrend, market comes down, spikes downwards. This scares everyone. If you just see that on your chart right here, you think, oh wow, the market's had trouble going up, it's not cracking this area, now it broke an uptrend and now it shot down. This causes a lot of people to click sell, and so now everyone gets freaked out and sells. All the smart money clicks buy because they know everyone is selling here at this price. They're all freaking out, they're all getting out of positions, but the smart money, the big hedge funds and banks who know what they're doing, they're professionals, they look at this and see, oh, this is a pretty good discount, I could run price up again. So then they run price up again, and then everyone starts to buy up here thinking, okay, well, never mind, I want to buy. So they buy up here at this high price, and the market starts playing with them again, you see. So these fast moves, the takeaway is that these fast moves are made to convince you to make an emotional decision, just like this right here. Market was going up and up and up. People thought it was good. Everyone who had closed trades in here sees the market going up, so they're like, okay, I'm going to buy right here, 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 or I'm going to buy here. And they see this happen, this huge move. That screws with everyone's head. It makes people scared, makes people nervous. So people close their trades right there at a loss, but then right after, smart money knows it's a big discount. So they jump in. You can see where they jump in because it'll be typically big candles. Like this right here is where they probably jumped in because they have enough money to cause price to move that quickly. I think it takes like 12,000 lots to move the market one price point. And so with a lot of people coming in or a lot of orders being placed, 12,000 lots, that's a lot. That's a lot of money they're throwing into the market, causing price to jump up like that. And you see, come right here, trickles down, more price, more quick candles. Those are all the banks and hedge funds playing with people. So let's go back here to this trade. Range, breakout 1, 2. This retests the range. Then a move to 3. You can also see that 3 is very, very long. It's a long move, typically the longest. Wave 4 comes back up and taps this area, comes down. All it does whenever it makes the 5th wave, when you've counted, okay, 1, 2, 3, 4, 5, you want to take this trade if it's divergent from the previous peak, which in this case it was. This made a lower low. This one was flat. And also what you'll see is sometimes it'll make that move, but it'll also come up again and then spike downwards even further to try to shake out scared people, to try to convince people to sell, anything to not get them to buy. Because if everyone buys down here, everyone's going to make money. The market makers don't want that. They want people to be freaked out. That's why they cause this crazy candle right here. So if you're just a retail trader, you see that, you're thinking, wow, I bought somewhere up in here, I'm closing out of this trade. The second you click sell, they all click buy and they take your money. See, and they just ran price up. So this is wave 5. We're going to take a buy right here. If the market spikes down quickly, you're going to enter again. If it goes sideways slowly or consolidates for too long, I'd say 20 to 30 candles. If it just keeps consolidating, just close the trade at a loss. If it's not doing what you want immediately, most of the time you'll see it'll just spike up to your profit target immediately. That's how most of these trades go. Typically, you don't get any drawdown. But the 10 to 20% that you do get drawdown on these trades, you want to manage that and you want to look at what's happening. Is it fast drawdown or is it sideways slow drawdown? And just understand what it means. So that's how you would have taken this trade. Stop loss would have gone just below here. I'd say maybe a 10 or 15 pip stop on this just in case it spikes down, you get another entry. I don't trade with a stop loss. I watch the market as soon as I enter. I'll usually set my profit target, but I won't usually trade with a stop loss. Unless it's like just a hard stop of maybe like 20 pips or whatever. Market came up here and played around, so let's just scroll through and see if we can find anything else fun. Tell you what, let's go to a different pair. Find something. You guys can see I've got my charts all crazy. Been back testing a lot lately. So let's look at this right here. This is something I want to go over with you guys. Market does this right here. So this is a range. We came up, so we broke out of the range, but then we didn't really come down and retest it. So some people will say this is wave 1, 2, 3, 4, 5. Here's something I want to point out. Wave pattern goes up and down, then up further, then down, then up further, and that's wave 5, then it comes down. Same thing with a breakout to the downside. The market is in a range, then it goes down, comes up, down further, then comes up, then down even further. If the market is just going sideways, it's not an Elliott wave pattern, it's not a breakout pattern. Like for instance, if you drew this as a range, number 1, it's not the highest or lowest point in the immediate market. See, so we have a higher area right here. You don't want to draw this as a range. If the market breaks below it, you would try to find a range up here, and if it's not clear, it's not clear. This right here, but let's say you did that, and you said this is 1, 2, 3, 4, 5, 6, 7, 8. You know what I mean? If it's just going sideways, just step back and wait for a clear pattern. So market broke out here, didn't retest, so there's no wave 1 and 2. Don't try to push it. Don't try to push anything or count something that's not there. Okay, so let's just scroll back. Let's see if this worked out. I don't know. Let's see if this. So I'm going to draw the range. So we had the market going up for a while. That's a good sign. Market was going up for a while, went into this little channel right here, broke out, came back up. So if you want, what you can do is you can consider this the range, but if you want to get fancy, you can also consider this a range. Why? Because it's an area that the market is interacting with. So this could be your bottom area. Market tapped this, cuts through it, taps it, goes up, tries to go, breaks through it again, taps it. So you know that this is a very big area. A lot of people are watching. You can draw this as the top as well, maybe somewhere in here, right here, you know, whatever you want, or maybe you can just consider all these upwards peaks. But you just see the market is in a little sideways channel right here. Broke out, came back and retested it before coming down. So let's see what happens next. So the market goes down next, see, and then it comes up and then goes down even further. So this is where a lot of discretion is involved. First thing I want to point out is the breakout. This is a clear enough breakout, comes up and retests, and then it tries to fall, but it doesn't fall right here. It comes up and tries to fight even more. Buyers are really trying to run price back up, but they can't. So then price comes down and then tries to go up one last time before coming down. So some people will do is they'll say, okay, here's the range, wave 1 and 2, and they'll call this 3, then this 4. And they'll say, okay, well, 4 retested the previous peak. So that makes sense, right? Well, here's the thing. Wave 3, this is not long enough. This is just, it's like the smallest little breakout. Wave 3 is the meat of the move, because wave 3 is the area where everyone freaks out. It's called stage 2 panic. Everyone freaks out because the market is making a huge move against them if you were a buyer somewhere in here. Stage 1 panic is where the market does stuff like this. It just kind of breaks out and chops, and you're kind of worried, but you're not going to close your trade yet if you're a buyer. Stage 2 panic is where the market quickly goes away from your position. Then you're freaking out. That's where stop losses are hit, and you know, everything gets all freaked out. So, but like I said, so this right here, invalidated because wave 3 is not really that big before it pulled back, but it did pull back and retest the previous lows. That's good before going away. So yeah, it's a solid area. I don't really take any trades off these anymore. I've gotten screwed a lot the past 2 weeks trading these, just trying to trade the waves, trying to map them out, because you typically don't know, you know, waves 1 and 2 until waves 3 and 4 are formed, and then by the time wave 5 is formed, the pattern's already completed, so you couldn't take any trades. So, and then this wave 5 down here, there's no divergence, there's nothing clear. Yeah, it still worked out, but there's just nothing clear. There's no clear moves to be made in here. So it's not a trade we would be taking. See if we can find something else. I want to find a good one. Some people said last week the market was like crazy, it was fun, and some people said the market was really slow. I don't even know how I would say the market was weird. I mean, Friday was good. I took a lot of good trades on Friday. In fact, let's look at Friday. I took one on EU on Friday, I think on the minute 5. What did I take? Yeah, it was this right here. So let me show you the trade that I took on Friday. This is in the group chat. Depending on when you're watching this, it could be a year later. Can't scroll through the group chat and find in our students chat. But this is sort of a range down here. You can, you know, draw it like that, you know, however you want. But just understand the market's just kind of chopping in here. It's chopping. So the market breaks out of that and retests it before shooting up. That's how you know it's a big confirmation. Okay, wave 1 and then 2. Market breaks out substantially. This area is substantially higher than this. You know this is a long move. This is wave 3. Market comes back. Where does it usually retest? So here, whatever it is, it's wave 1. So the market comes back and it retests, right, this area. So if this is an area, the market, yeah, if it comes all the way down here and then shoots up, that's a really good sign. But the market just pulled back. It came around this area. Then it started going up more. So all you're going to do is you're just going to kind of use a little bit of discretion and say, okay, the market pulled back and started moving up again. Right in here is when you would have known, okay, this is probably the low of the pullback. So if you're counting these, here's our range, right? Breakout, wave 1. Come down, taps the range before going up, wave 2. Huge move up, wave 3. Pull back, this is wave 4, and like I said, most of the time it'll come and tap where wave 1 ended. This one almost did, you know, whatever, came down, wave 4, and then a final move up to wave 5 before you start seeing divergence. Now this is what you would have seen initially right here. Okay, so you would have seen this and you would have said, okay, this is cool because look, these peaks are divergent. So you got to understand, yeah, they are divergent, and yes, it is wave 5. Very, very strong indication the market is going to drop soon. I'm going to take this line out here just to not confuse you. So here's what I saw when I saw this. I was like, okay, breakout, retest, wave 1 and 2. Another breakout and retest, waves 3 and 4. And then it shoots up to wave 5. You know, it's higher than this one. Understand the market moves out, comes down, moves up higher, comes down, moves up even higher. Cannot go sideways. You can't say this is 1, 2, 3, 4, 5. We're in a channel. There's no breakout. Okay, this is a clear breakout. 1 comes down, 3 comes down, 4, 5 goes even higher. Then 5 is usually when you see the market chopping. Rule number 4 of the divergent strategy, here we teach in the training at Mission FX. Rule number 4 is broken. There's more than 20 candles between these two peaks. Too much chop. Way too much chop. Way too choppy. So what I usually do if it's not a good divergence, like this is still technically divergent, yeah, and you can still see that the market, once it made this higher high, it came down. But this is only for like maybe like 10 or so pips. I don't know. Market comes down right here, but then what happens? The market shoots up again. So what I do is whenever I see a wave 5 divergence that's not necessarily tradable as we would trade here at Mission FX, I wait for the market to make a spike even higher. So what I did is the market came down, spiked even higher. I took this sell right here because if you're looking at this, you see that this right here is divergent from this. And this is a setup that validates all 4 rules in the Mission FX training. So let's just connect these two peaks. So the market came up here near the 75 level, rule number 1. Market came down, shot up quickly right here. This peak is lower than this one, while on the main chart, this peak is higher than this one. So our peaks are going up, these peaks are all going down. See how each of them are lower? The market's losing its strength. So a couple indications to place a trade. The reason number 1 is we have a little divergence right here. Reason number 2 is we have a bigger divergence from here to here. These peaks are divergent. Market is trying to rack up higher. RSI is failing to do that. RSI is failing to make higher highs. And then rule number 3, I'm sorry, not rule number 3, but reason number 3 is that we're on wave 5 of a 5 move pattern, of a 5 Elliot wave pattern. So 1, 2, 3, 4, 5, and then divergence. Okay, so right here, I knew it was a solid time to trade. So I took this trade right here, came down, spiked up again. I took another trade in here. I literally got in on the wick because once you're taking everything into account, you know, okay, the market's overstretched. Buyers are coming in, they're trying to run price up higher, but they're barely making higher highs. They're barely able to get up there. And so, yeah, so I took a sell right here, and then I took a sell up here, and the market came down. And then as you can see, I was out pretty quickly. I was out within a few candles, but the market came down here. I think my profit target was 4.3 or 4.7. I think I was out somewhere in here. As you can see, the market came back even more before trying to run up again. Coming down, the market closed right here. So, but this was all the trading was done right here. So, like I said, as usual, some of the stuff that I say, it may confuse you, so let's break it all down, start to finish. This is what you would have been seeing. Market is being boring. Maybe y'all took some trades the night before in here during the session. You see, maybe took that divergence right there. Not a divergence I would trade. Why? Because it hasn't completed a 5-wave Elliott wave pattern. Hasn't broken out enough. This is a sideways range. The market breaks out in one move and then makes a divergence. I don't trade that. The market has to break out, come back, break out even more, wave 3, come down, break out even more to wave 5, and then make a divergence. That just means that the market has been going up a very, very, very long time before you expect it to come down. This could be just a stop hunt. This could be a huge move that's going to be really, 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 really long, and it could ignore the divergence and keep going up. So I just wait for the 5-wave pattern. I wouldn't have taken this trade, but a lot of people do, and it's okay. So right here we see the market going sideways, breakout, doesn't really do anything crazy, to another range, breaks out, retest before going up. So I started watching right in here, and I said, okay, market was in a range, came up, tapped it, went up. So I'm like, this is 1, 2. Now I'm going to wait for wave 3 to complete and wave 4 to form. So sure enough, wave 3 came up, wave 4 came down to here, and the market shot up even higher. So right here is when I knew, okay, I'm going to start looking to take my trades. You still would have been good shorting right there, but like I said, this is just too long. It invalidates wave 4 of the 4 rules here at Mission FX. So I just don't take that. I like to play it safe, take good trades and get out. So this is wave 5. I waited for another push up here. As you can see, as soon as I entered, went straight into profit. I didn't close the trade though because I wanted to catch more money. Usually, like I said, if you're entering right here on a sell, you take your profit at the previous support resistance area, which would have been right here, just this previous area where price bounced. So I would take mine right there because typically price will bounce. as you can see, yeah, that's what happened. I stacked again right here, sell. See, fast drawdown. I stacked again on a sell. Came up, I took my profit. So yeah, it would have been right there where I said 4.7 or something, whatever this was, I guess. Yeah, 1.1947. Yeah, so that's why it was 4.7, is because it was this previous peak. So right there, 4.7. If you entered, my best entry was right here below the 6.9. So it would have been here to here. So that's 15 pips, 15, 16 pips. So that's like a solid trade, and it went down even more, you know what I mean? But still, 16 pips, 2 entries. Maybe the first entry got 12, maybe the second entry got all 15, 16. You know, you're catching 30 pips off a small movement. If you just take 1 or 2 trades like that a day, you know, you can get 40, 50, 60 pips in a trading day, and, you know, with relatively risk-free as long as you're following the rules right. So that would have been my trade right here. Stop loss would have gone just above. I would have probably put like a 15 to 20 pip stop if my target is, you know, 15 to 20 pips, which in this case it was around 15. And then you just ride your trade down. And if you've done everything right, the drawdown, a little bit of drawdown shouldn't scare you, and the market should quickly come to your profit target. But yeah, so that's the reason. A range, breakout 1, 2, 3, 4, 5, and then divergence at wave 5. A series of divergent peaks here at wave 5. Sometimes it'll just do this. It'll make wave 5 a divergence and then come down immediately. But sometimes it'll try to make another move up, but you can see when the market's getting worn out, means the uptrend is probably very close to being over because we've been going up for a while, and now the market's having trouble making higher highs. It's barely being able to get up there. RSI is going lower, showing the market's losing its strength. So as you can see, it turned over. So that's a good example of a trade I took on Friday. I think there was one on GBP, JPY. I can't remember the time frame. Let's see if I can find it here. So let's look on minute 5. It might have been on minute 5. I think this was it right here. So this right here is a range. I don't know if I did this on the minute 1 or minute 5. Yeah, so I think it was on the minute 5. But anyway, you see price chops around at a low right here, and this is a very big support resistance level. So let's draw the range real quick. This will be the last example. It's a 30-minute long video. I know you guys love sitting here listening to me talk for 30 minutes. So anyway, there's the bottom of the range, you know, or here, whatever. But the point is, you know, price was chopping around in here. This is a long range. Price broke out of that, tapped it, tried to go, but then it comes up again, taps it, and starts moving up. So right here, I'd call this my range because of this long series of validated lows. Price goes down in here and then pops back up, kind of stutters right here before going up again and then making its move. So this is our little range. Yeah, it's not a very long range, but it's an area where you can see price has tapped this a lot of times. Price quickly got rejected up here and shot above it, tapped it before moving up. So this is our low area. So price shot up, came down. This is wave 1 and 2. Yeah, the market will sometimes do weird stuff like this, like it'll tap up and you go. But remember, this can't be wave 3 because this is not long at all. So if you're counting wave 1, 2, 3, you can't count this because it's not a very long move. You want wave 3 to be a very big, substantial move. So I considered this to be wave 1, 2. It tapped this previous area, so that's good. Then wave 3 pulled down to wave 4, and the market shot up to wave 5. Now right here, wave 4, yeah, it didn't tap this low right here, but the market came and tapped this area before shooting up, making a higher high. It still counts as wave 4. It's not mandatory that it retests this previous wave 1 peak, but it is a lot better if you see a pullback that clear. But this right here, I'm just so familiar with the pattern that I just went ahead and took the trade. So low, the market broke out of that area. So wave 1, 2, 3. See how this is a long move? 3, 4, 5 went higher. See, like I said, very important. Makes a high, comes down, makes a higher high, comes down, makes a higher high. 1, 2, 3, 4, 5. Up here, took this divergence right here. So 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13, 14, 15, 16, 17, 18, 19, 20, 21, 22 candles between the peaks. So that did break rule 4, 2 candles between the peaks. But for me, since I know it's wave 5, I know it's a fast candle, what you can do is you can wait until the market makes a higher high. But I've just seen, man, as GJ, the market's been moving up for like a long time. From 147.63 to 148.50, that is what? That's like almost 100 pips. That's maybe like 87, what is that, 87? Something like that. 80, 90 pips. The market's gone up a long way now. It's making a divergent movement. So I took this trade and brought it down to like right in this area. I only think I took 10 pips off this trade. So literally from here to here, that's it. And then, yeah, but I mean, it's still simple enough. You're just looking for breakout wave pattern and then divergence at wave 5. So we had 1, 2, 3, 4, 5. And I'm counting it over and over again. I want you guys to understand it and see it a lot of times. So these peaks are divergent. Take your trades there at wave 5. Also, if the market would have given you quick drawdown, okay, we're already at wave 5. That quick peak is probably going to be divergent here on the RSI as well. So if it is, you take that trade again, enter a sell again. Take profit. If your take profit's 10, 15 pips, put your stop loss 10, 15 pips. But don't get stopped out on a divergent move. That's why I don't program my stop loss in. I wait to see what the market's going to do. If the market does something I like, which is like a fast move up that's divergent, that gives me a better entry, then I'll take that trade. And that's just how I trade it. So you can still hold your trades if you want even longer. Just put your stop at break even. Like I said, I'm out at 10, 15 pips if we're on the minute 1, minute 5. Minute 1, 5, 10 pips. Minute 5, maybe 10 to 15, maybe 20 pips on a fast moving market. And then I do all my trading and I'm done for the day on that. So that is how we trade Elliott waves. That's how we trade divergence on the 5th Elliott wave. And I've shown you where to take your trades at. And then how to manage your trades based on price action when you're in them. When you're looking at stop loss and take profit, where your target should be, where your stop would be, just so that you understand, okay, is this trade working out for me very quickly, or is this trade giving me trouble? Is it looking really weird? Is it looking funky? Is the market not wanting to go right into profit? Stuff like that. Just rewatch this video a couple times, especially where I talk about, in the first example, all your targets and stuff, and where they should go. And hopefully you'll be able to get the sense of Elliott waves here within a few weeks. And after you learn them, it's so easy. It's just reading a chart. You can do this in like a few seconds. Like you can be like, you can see price right here. You can see, okay, well, price is right here. Let's see where we're at if we're in a pattern. So you look all the way down to the low. You see price break out and tapped that area. See, price broke out and tapped it and came up. So you're like, okay, well, hold on. This is 1, 2, 3. Okay, this is 4. Now price is going up here. So if it goes up even higher, that'll probably be wave 5. Went up higher, started turning over. So then you knew, okay, this is good. Also, if you want to get technical with it, I don't really teach this, but it's just, you'll see if the market breaks a trend, it'll usually come up and tap the lower side of that trend before falling. So right here, a lot of people, I'm sure, sold right here, mid profit. I don't really teach that because it doesn't work out as much as divergence. But yeah, it's still an extra confirmation. You see the market tries to come up again, but fails to make a higher high up here. So the bullish momentum has lost. The market's now turning over, going down. So yeah, I hope you guys learned something new in this trade. Again, Nick Sean of Mission FX here. I'll see you guys in the next video.